What's my edge in oil trading? Conviction. With Sparta Curves, I get real-time, trusted prices from 30-plus top brokers. Futures, swaps, physical, and freight, all in one place. Switching from Bloomberg or Refinitiv only took 15 minutes, zero disruption. Now, our whole team runs on one flow. Sparta Curves. 45 days. Free. No risk. No friction. Just conviction. Start your free 45-day trial by visiting spartacommodities.com/curves.
Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
So hello and welcome to another episode of Sparta Market Outlook podcast. I'm your host, Rachel Williams. So this will be episode 46, which means we are rapidly closing in on a full year of podcasting. Goodness, how time flies. So this week we've got lots to talk about, not least the aftermath, if we can't call that already, of the Iranian crisis. So look, we're going to break down what's next for the market from there. And then, of course, we had EIA's stats, which showed the US is pretty tight on oil inventory. That seems to be a theme that we've been picking up on some time already, listening back to the previous podcasts. So this week, we've got a return of two veterans. So Phil Jones-Lex and James Noah Beswick, our double-barreled, cross-barreled oil experts. And Neil is once here again. So hi to all.
Hi. Afternoon.
Hey.
Okay, so why don't we just get into this one and start? So Neil, you can take this away. But I imagine we've all become experts in geopolitics this week for sure. So what are the important points to note on Iran now? Know that we've had a de-escalation, maybe?
Yeah, I can make some statements and you guys can rip it apart if you like, but let's just make some statements, right? Obviously, the whole situation is now on paper over, and prices to a reasonable degree reflect that. I think the market is still slightly wary of the aftermath. I don't think we can really say that the situation is completely resolved. And obviously, the headlines earlier this week revolving around whether the ceasefire was actually being upheld or not was also spooking the market a little bit with that respect. It's been a bit quieter over the last day or two, I would say. So it's quite stable, relatively speaking, to Monday or Tuesday, but I think there's still an element of the market feeling that this has not resolved itself fully for the time being. Is that a fair statement for you guys?
Yeah, I think
makes
so.
sense.
You've also had Trump on a flight to Europe, so.
I think the statement that you made before that as well was pretty clear. I would say, kind of, you had some rumours of ceasefires not being held and the likes, but then it was quite definitive actually with what he came out with. I think it seems as though he would like this to be over for now.
No violence and oil prices down, everybody, right?
Everybody drill.
So, but that brings me, so the two bits of news that were, and we don't want to spend 10 minutes on this because I think for large pricing purposes, this thing is over for now, right? But the last couple of days of headlines have kind of revolved around leaked intelligence reports about how extensively Iran's capabilities have been damaged. And there's quite a lot of back and forth, and I think that's something that is causing some concern. And that is a good segue into just a couple of statements about what has happened now. So Iran has basically, just to put this in very short order, Iran has found a short-term way out, and they were under a lot of pressure. That's probably fair, right? They were basically on the verge of getting cleaned out. and they are still very vulnerable to attack. And
Yep.
as far as I know, the airspace over Iran is still basically free. Trump has found a solution in inverted commas, so to speak. He's marketing a massive win. That's probably fair.
Yeah.
But for the Israelis, it's not really over. If we make the statement that Iran has been set back some months, but not permanently, then we're back here in 6 months' time, or maybe 12 months' time. We're not quite sure yet. But for the Israelis, the thing's not over. And for Iran, it's also a fair statement. The last couple of weeks have proven that they are only safe when they make a bomb. That's probably a fair statement as well. Do you guys want to add anything to that?
I think kind of for me, it would be more interesting to look at the pricing action kind of around this and getting your thoughts on that. I think all the statements that you made are fair. So we feel as though there's a little bit of a still kind of in the water, but clearly kind of still massively headline driven, right? But look, just quickly, so what happened to prices during this and where are we today?
Well, we can talk about flat price, which is maybe one way of looking at it. We're down $10. Which is, it's almost back to pre-crisis levels, I think. And there's an argument to be made that that's quite interesting by itself, because it's a region that's still kind of on the brink, but all of the geopolitical premium in flat price is basically gone, and potentially then some, given that the risk is still high. And then time spreads did similar things. I think all of the kind of east-west signals moved for the most part in the way they should, although a lot of the east-west signals are still wider than they were pre-crisis. That's probably fair as well.
Yep, exactly.
And so physically speaking, it's less normalized from the east-west perspective than flat prices. And freight is also collapsing where it should. So if you look at TD3C, TD3C. There we go. Yep. Thank you. That is back to pre-crisis levels. That's collapsed. And there's a few outliers that we want to talk about later, something like TC14, which, let's pick that up at a later date. Anything else to add? I'm conscious that I'm talking a lot.
No, I think the AG or East of Suez in general, clean freight is still pretty elevated. I know that kind of I'll talk about it, or we'll talk about it a little bit in more detail later. I think that one looks as though it's probably more like a kind of gradual return to normal rather than a dramatic one, as we've seen obviously on flat price, and maybe the East-Wests then follow that more than kind of a very rapid return to where they were.
Yeah, I mean, I would say the freight issue is not just a reserve for TC14, TC5, TC20, TC18, even like North Asian loading freights. All freight is elevated globally on clean. But apart from that, I'd agree.
Yeah, we'll pick that apart. Interestingly, we had an exclusive breakfast briefing this morning in Geneva with a select bunch of senior analysts, and freight was actually quite an important topic that we spent quite a considerable time on, TC14 being one. It was great to have Michael in the room, but looking forward to kind of sharing that view kind of with those listening on the pod shortly. Okay, so what now on Iran then? Is there anything else that we can say here, do you think?
I don't have much to say. I think it's just wait and see. Like, there's nothing really that's tradable at the moment. I don't think you need to be kind of exposed to the long side at present. As I say, it's kind of surprising that, and we'll talk about it in a second, OECD oil inventories are extremely low, and we're still in a high risk environment in the Middle East. So it's kind of surprising that price is this low. Maybe flat price, but maybe that's the only thing I can add. You guys?
I think any more strikes from Israel, even, but obviously from the US, but even from Israel, would need to be kind of telegraphed to a certain extent, in that Netanyahu would need to build up that, not excuse again, but the justification before before that happened. So whether that is more IEA reports about they haven't destroyed the uranium that they were looking to destroy, for example, but I think we would see some reports and some news stuff in at least kind of a week or two even before anything actually happens. I don't think we're going to see new strikes out of the blue.
It's a great time for tinfoil hats, right? Because there's lots of thoughts flying around about how Israel might engineer that kind of situation, right? Maybe engineer an Iranian strike, or some kind of situation that will allow them to keep this thing going. Because as I said, the incentives are definitely not in favor of peace.
They need a new casus belli, exactly.
Yeah.
Okay, so we've got a bit of a wait and see then. So I think you've already mentioned it before, but this week has also been interesting in that we've had two decently bullish data sets for inventory releases. So you mentioned OECD anyway, but do you just want to do a quick roundup of that, where we got to?
Well, let's do a quick roundup. The super fast one is that it's Jody for April, which of course is April. It doesn't give us an accurate picture of what's happening right now. And there's the EIA stats that were released yesterday. So Jody, I thought, was bullish. Middle distillate stocks were drawn again, and I think they're close to 2023 levels in Europe. Light end stocks look okay. Crude stocks were drawn again. Overall, OECD builds for total oil this year have not been huge. And if you compare that to what we were talking about in terms of the forecasts for this year, we're still miles off. And I think you can see the result of that in the US stock data that's weekly just now. The US is super tight. And I think there's maybe one aspect that I haven't mentioned too much on these pods so far. The one is that a lot of people are looking at Chinese oil inventory. So the Chinese have built crude stock this year, decent sized, some of which is SPR though. And the question is how relevant this is to pricing, because you could make the argument that the market prices off of OECD inventory partly for a reason, because a Chinese stock build is not the same as a European stock build. I think we all know that that's true. And so the market's like focusing on that and oil and water, which can always get revised and is problematic. And meanwhile, OECD inventories are just low. And that's another one for the US, right? The draws yesterday were huge. Crude is super tight. Products is pretty tight. Cushing's very tight. It's just constructive. I mean, we've been saying it for weeks. It might change, but it's just very constructive. And maybe the narrative will change over the course of the next 3 months. Maybe we get OPEC coming in and telling us they're going to do another 800 kbd of hikes, and this will be real in the terms of it. More of it will show up in exports. But for the time being, I don't see why we can't still be fairly constructive on things like time spreads, generally speaking.
Yeah, okay. We'll get into kind of the Cushing conversation shortly, I'm sure. Keen to give you a bit of a break, Neil, so you can grab yourself a water. Let's dive into the physical light ends then. Phil?
Sure, thanks. So the first thing to note is that we mentioned, the podcast mentioned last week that EBOB spreads had kind of done the opposite of following outright price. And so as risk off kind of came in at the beginning of this week, we saw EBOB spreads rallying, but they've come down again now. And so just looking at kind of why that is, we pegged the EBOB spreads partly to the signal that the East-West were moved in favor of ARA arbs arbing into ARA barrels arbing into East Africa instead of gasoline coming out of either Singapore or the AG, for example, which should be a kind of relatively bearish or supportive factor for EBOB spreads. ARA is also the kind of origin of cheapest supply into a lot of LATAM destinations, which again should be relatively supportive at least. I don't know if on the last kind of day or so if there's something to do with weaker TA arb outlook that's now probably driving those EBOB spreads. So the latest, obviously, on the TA arb is that if you take RVO out of it, and RVO has obviously been quite volatile recently, But actually for July TAR, but we're now in pretty solidly negative territory, which is kind of unusual for this time of year. And or at least I think this morning it was minus 150 cents per gallon or so on a net RVO basis, and it's now at something like minus 0.6. But despite that, we have an almost open ARA blender margin for moving RBOB into New York. So from an ARBS perspective, we should be relatively constructive for EBOB, and we also have the thing that we've been talking about for all of the year in terms of open EBOB blend margins. They are now still just about positive, but narrower than they have been for quite a while. So I think kind of it should be looking relatively constructive. The fact that spreads came down over the last day or two, for me, just maybe gives a little bit more of room to the upside now over the next couple of weeks potentially, because as I said, the fundamentals on the ARB side at least do look pretty supportive. The other thing on the light ends is naphtha. Again, focused on Northwest European naphtha in this case, or the Northwest European naphtha spreads, which over the last couple of days have gone from a kind of $6 a ton backwardation down to parity, if we're looking at July, August. So I think it seems as though there's probably a bit of a room to rebound there as well. ARBs out of the Med and even some ARBs out of Rotterdam are open to the east. So that kind of that typical supportive factor for European naphtha remains. If we're talking about decent, an uptick in ARA gasoline blending demand, then that should also be relatively supportive for the European naphthas, at least the ones that are gasoline relevant. I suppose the only caveat, and maybe this is to throw it back to Neil, would be that maybe it's just that we still have pretty strong margins in Europe, in Northwest Europe in particular. So is naphtha maybe being sold off on expectations of max runs and therefore higher straight run supply?
Don't know if I can answer that question very easily. Fuel oil doesn't necessarily look like it is doing that, just if you're looking at both intermediate products. And the other thing, I guess, would be, it's not answering your question, but one thing that we are talking about is just gasoline, diesel spreads, right? So now there are huge incentives to produce diesel over gasoline. It doesn't look like from the US data that is happening yet. In fact, James, I guess you'll pick up on that later. Diesel yields are really low. I don't know if I can answer that question. My impression from NAFTA is that Europe has been bid down so that it can make the East-West situation work. And there's still, reports of very strong Chinese imports. There's fear about Middle Eastern supply. So my impression was that the East-West NAFTA has had to make that work. But from I think runs are probably strong. That could also be adding to the NAFTA weakness in Europe.
Yeah, I think I would probably stick to an expectation that Northwest European naphtha spreads can rebound then slightly from where they are. Maybe it was a little bit overdone, that correction. The only other thing on the light ends, just to bring it back to that freight conversation that we mentioned earlier, at least for gasoline in the east of Suez, so it's both for the AG and Singapore, the blend stocks that we measure, that we run our blenders on, are obviously largely delivered diffs on those components into either Fujairah or to Singapore, which means that the high freight rates are pushing those diffs higher. And then once the grades have been blended, then you get a double whammy because you have the freight exposure again to try and move those grades to their final destinations, which is why we are still seeing ARA as the choices, supplier of choice into East Africa and Australia, rather than the AG or Singapore, where it would usually be pulling from at this time of year.
Cool, thanks, Phil. Just on the gas naphtha bit, or kind of gasoline diesel kind of yield switching though, if we're cutting kind of deeper into that to kind of produce more distillate. The consequence of that is naturally you will get kind of a little bit more naphtha out of the yield piece. So maybe one to think about, and maybe one to get June, our wonderful refining expert, back on next week. But it's certainly one for us to debate kind of internally, and maybe update next week on that one. Okay.
I mean, just to add to there, sorry. It's quite interesting looking at the US stats. I mean, the weekly numbers are very tricky, let's say. You have to take everything with a pinch of salt. But it looks like the US is generally short of resid. So if I look over the last month, the yield picture is like gasoline yields are down, diesel yields are down, fuel oil yields are down, and the only thing that's up is jet. And we've been talking about this resid problem for a week or two, and maybe that's the case also in Europe, because once we go to crude and talk about crude, the heavy kind of crude is bid up everywhere. So that, I guess at the margin that also makes it more difficult to produce more diesel, because you just have more light ends cuts, so to speak.
Well, more like crude available kind of to run. Okay. On that, good segue into distillate, actually. When we did a bit of a round table this morning, in terms of where everyone's focus has been on over the last 2 weeks. Now, I don't know whether that's a consequence of the people in the room, but there was clearly kind of a really strong show of hands for the distillate side. So let's talk ice gas oil and diesel in general. So look, we've had some healthy discussions this week internally as well, on some pretty interesting price setups. James, why don't you take us through it and round up where you think ice gas oil spreads are just now?
Yeah, where are we? So, as Neil and Phil were speaking about, most of the Middle East conflict risk premium has come out of the Middle East distillate market over probably the last week or so, half a week even. However, we've seen a bit of a rally in ice gas oil, heating oil, MOPS, diesel spreads over maybe, and cracks as well, actually, over maybe the last 2 days or so. I guess my view is that's mostly down to the kind of faltering in the ceasefire, perhaps, that Neil was kind enough to speak about. We've got Sika and Middle Eastern diesel in general marginally pointing east at this point. Now, if the Iran situation remains calm, we should probably expect the east-west to narrow a little bit from here as well, while also probably continuing decline in European premium that we've seen over the last few days as well. Although on that east-west discussion, there does seem to be signs that Chinese diesel exports will increase as we move further into July, actually. Now we've got the HOGO indicating that the US Gulf ARB to Europe is closed currently, or the ARB is closed, very close currently now. The HOGO has actually come down or narrowed a little bit after the crisis, but really the thing that's kind of keeping it closed is that massive uptick we've seen in TC14 freights that Neil also spoke about earlier. Sales prices, as we just discussed, in Europe are really coming off pretty hard now, although from a very high base induced by the Middle East conflict. And US diesel stock and middle distillate stocks in general are very low. But actually, when you look at like last or yesterday's figures, in large part that's due to high diesel exports. And we've got continuing declines of Brazilian diesel premia. So what US Gulf exports there are at present should be pointing to TA rather than Latin America. Now, if we move on to jet for a little bit, we've seen that the divergences caused by the Iran conflict have mostly reconverged since then. We've seen that follow pretty much the gas oil east-west in converging again post the crisis, essentially. We've seen the Northwest European jet regrade, the CIF diff essentially, fall off a cliff. And interestingly, also the New York jet diff fall off a cliff as well. And I think that's a sign, again, something that's shown in the stats, that US jet stocks currently, reflecting the high yields that Neil was talking about, are actually at record levels currently, which is actually a very, very different picture to diesel. And we're seeing that Middle Eastern jet arbs to Europe via the Cape are closed at present, mostly caused by that real drop-off we've seen in European jet pricing. And as we go into that kind of the peak jet demand period of the year, that might be a little bit surprising, actually. And as something like my colleagues have spoken about earlier as well, we're just seeing strong freight everywhere when it comes to distillate. US Gulf Europe, Middle East, North Asia. Although when you speak to our freight guys, they do kind of see TC14 at least quite overvalued at present.
Yeah, can we delve into that one a little bit more? Because that I appreciate kind of you had Michael on the podcast, but for those that may have missed kind of last week, it might just be good to run through kind of our thoughts on TC14 there.
Yeah, I can give you what basically Michael is saying.
Go for
so,
it. Yeah.
I mean, maybe we can just couch this as well. I mean, one of the internal dialogues just now is to say, okay, the US Gulf MR to Europe ARB for diesel is super closed, and much more closed than we've seen it
for a long time,
forever probably. And the question is, why is that? What needs to happen now? And one of the more obviously high valuations is TC14, right? Because you already have July, August ICE gas oil at plus 14. Actually, it's plus 16 now. And so the question becomes, do you wait for freight to fall, or does ICE need to bid up? And the problem with freight just now is that there is genuine tightness in vessel supply in the Gulf Coast.
Indeed.
Yeah.
And there's a further complication in that it's the 4th of July holidays next week. So there's a lot of forward fixing happening in the US. And so the upshot is that this freight rate's going to be sticky for the next week or two, maybe.
Yeah.
A slow drift down is basically what we are thinking, but not a collapse anytime soon. So then the question becomes, okay, the only way to make this ARB work, or one of the only ways, is really the ICE gas oil spread, because we think the HOGO has limited chances of coming off because Pad 1 stocks are super low. There's a RINs problem. It's hard to trade. And if you're of the opinion that Europe needs to price to open up this ARB again from the US, then ICE spreads need to rise, and they might have to rise a long way because the ARB is very, very closed just now. Is that a fair statement, guys?
James?
It's a fair statement. I guess it's not. I think it's a hard one to call. I guess it's a not statement that I completely agree with. I guess I think it's a very fine balancing act, but if I had to call it, I'm more bearish like July, August. And some of the arguments for that. So, the ARB is very closed now, but kind of from the start of June, probably the first 3 weeks of June, it was continuously moving towards open and flash very open during the crisis. And I think the EIA stats from yesterday kind of, which confirm high exports, kind of confirm that there should be a lot of US Gulf diesel on the water to land in Europe in at least the first half of July. All told, US diesel demand has continued to decline and should continue to decline from here over the next few weeks. European refining runs are strong now and should improve from here, and particularly with strong refining margins, and they should be incentivized to run max diesel from here as well. Indian diesel exports should be increasing from here as well as we move further into the monsoon, reduced demand, therefore more exports.
Yeah.
I guess at $14 per ton, I would be looking to sell the spread now. I do think it's a very close call. But also, as you say, there's some big caveats there as well. How much the Middle East conflict has spooked essentially east of Suez imports into Europe for July arrival that we don't really have a very clear picture on. As we've spoken about numerous times, the low diesel stocks in the US at currently as well. So how much more have they got to export essentially? And the width of the HOGO now tells a story about that as well. Pad 1 stocks are really, really low. And yeah, as you kind of said, ARBs from everywhere into Europe, really apart from the Red Sea, are very, very closed at present. A lot of this is freight, but it could be an argument, as you say, that we might have to price up to pull these ARBs in. So, it's an interesting one.
Well, maybe there's just a timing element, right? Because what we're getting from speaking to people is that the US flows to Europe are already quite large this month. So that will arrive in the next week or two, I guess. And if anything, there might have been a uptick in Eastern supply to Europe based off of the ARBs that were open in mid-June. But those will arrive in late July, I guess, right? although the market will see it beforehand.
Yeah.
So it's kind of like, I'm almost tempted to say maybe the August-September spread is got more reward in it. Because we can make the statement that the US wants the ARB to be closed just now because its stocks are now super low. So maybe it's justified that the TA ARB is now very shut. But what are the consequences beyond July expiry? Does that mean maybe August, September is worth a punt? I'm just trying to,
Yeah, I would agree with that. Yeah, I
Play
think
it
maybe
forward.
August, September, maybe this has become more of an August story, but then there's also caveats to being long August, September as well. I mean, like, so we're saying our freight team is saying that freight should come off again, so we should see ARBs opening into August. There's enough time to do that now. Increased Chinese diesel exports, possibly widening the east-west.
Maybe.
Exactly. The whole kind of east of Suez distillate balance looks like it, or should be widening into Q3, and so that should be, I guess, to an extent, then pushing into the west as well. So maybe a caveat there.
Okay, so potentially kind of August Sept is one to continue to watch then going into next week. Did we get confirmation on Chinese exports stats, by the way, this week? No? Okay, all right then.
Yeah, well, June was kind enough to share some stats with us about July exports, that diesel exports are set to be slightly higher from China and jet ones slightly lower.
But they don't correlate well with real flows. That's one.
I was going to say.
Right?
I mean, but it's still an indicator, I guess, to a certain extent. A number kind of floating in the market there for us all to look at. Okay. Anything else on the distillate side that we need to cover? Sounds like that's a conversation that's going to carry on kind of going into maybe not next week because the US is potentially off, but certainly run over the next couple of weeks. Okay, crude. Let's turn to the crude market. So Neil, take us through what's happened in prices and what we should be looking at over the next week or so.
Yeah, I mean, I sort of I've written something in the script here, but I kind of want to, there's only really one story in town that's very important just now, and that's the US market, I think. So just a quick roundup then. Since Monday, a lot of spot premiums have come off. The Middle Eastern spot premiums have come off a lot. The freight from the Middle East to the East, to the Far East, has come off a lot as well. Brent spreads initially dropped off. Now they've picked up again post EIA stats. The Brent Dubai swap also came off a little bit, but is still relatively wide, I would say. And on TI Brent paper, we're now at minus 270, which is pretty narrow. So I think that the most interesting thing is the US market is super tight, and there's various aspects to that. Obviously, the stocks are low. I think there's also an additional problem, which is a lack of resid, which we've talked about already. You can see that in various things, right? One obvious one is like US residual fuel oil stocks are extremely low. I mean, they hit a bottom in late 2024, and we're now below that level already.
Yeah.
You can see it in a lot of diffs, right? So look at Sverdrup, for example. I mean, I think Sverdrup has a tendency to blow out and then come back in again. You can see that in the history. But Sverdrup is extremely expensive, and so is Guyana crude. If you look at the diffs for LATAM heavies like Castilla blend, they're all quite strongly up year on year. If you look at the Canadian diffs, the kind of Hardisty diffs and things like that, they're also still very, very strong. And you can look at, for example, the PAD 2 imports data, which basically represents Canadian imports, and that's also super low, super low, possibly even lower because of the wildfire issue. So there's a genuine lack of resid. This is relevant in the ways that we've already discussed. It might also be relevant in Cushing itself, because you probably use resid to blend with super light stuff and produce domestic sweet blend, which can be kind of varying quality, unlike the NYMEX spec. And I think all this paints like quite a bullish picture for WTI. And the problem is MEH is now negative. So the MEH Cushing spread is negative. And that's there for a reason. It's trying to discourage the flow of crude from Cushing to the Gulf Coast.
Yep.
And what that is doing at the moment, combined with weaker freight, WTI is now cheap into Europe, and it actually landed values against Murban in the Far East are now narrower than they were over much of the last month.
Yeah.
So WTI is kind of almost cheap everywhere. And I think the question becomes, is this going to be allowed? And I would make the assumption that we cannot do anything on the FOB side. US
Go
exports
through
have
that.
to...
Yeah, we talked about that earlier, but go through kind of why we can't do anything on the FOB side, or why the cash diffs can't kind of come off.
Yeah, I mean, the
Or
FOB
go
is largely a function of MEH, right? And MEH can't be bid up to try and make TI more expensive abroad because it's trying to stop crude flowing into the Gulf Coast.
Yeah.
So one of the only things that's really left is to reduce exports via the TI Brent spread. I mean, it's obviously not as simple as that, but I think there's still a very strong chance that TI Brent paper spread has to move to something like minus 250, or maybe it can even approach minus $2, as sort of silly as that sounds. But there's a real problem of low US stocks, and at the moment WTI is very cheap in the export markets, and I think that can't necessarily be allowed. And there's one more part to that story, which comes largely from June. So the feeling is that Eastern refiners have been on the sidelines, obviously, in terms of buying over the last 2 weeks for obvious reasons. And now they're basically back in the market for spot Middle Eastern grades. And so the thought process is that Middle Eastern spot premiums are going to rise, and that is going to make WTI and possibly to an extent Brent-linked crude even cheaper, or not even cheaper, but relatively cheaper into Asia. So that becomes another problem. So my question is, if TI is the tightest part of the market, TI Brent basically needs to narrow from here.
Just a quick one from me. Is pad 3 maybe, I mean, and obviously pad 2 as well, if we're looking at that not just as a volumetric issue, but also as a quality one, so in pad 3 as well. And so in terms of maybe just putting it out there, maybe TI can still export from the Gulf Coast because it's not necessarily that quality that the refiners in the region need, right? They need to be, maybe they need to be importing more of those LATAM grades, and maybe that's why those LATAM grades have some room to the upside, or just kind of residue rich crudes out of the Atlantic Basin coming into, or elsewhere coming into pad 3. But maybe it's just that the refiners in the region don't need more light crude.
That's one way of looking at it. I mean, just to fill out that thought, supposedly US seaborne exports are relatively weak as well. It's not just a Canadian issue. So it seems
Imports,
like there's
the seaborne imports.
Exactly, yeah. Sorry, I don't know
okay.
what I said. Seaborne imports. So there's kind of speculation about why that is. One obvious factor might be the decline in Venezuelan production. Mexican exports are reportedly quite low as well. Maybe more is actually finally being fed into the domestic system. Mm-hmm. So it might be that they need more of this crude, but apparently they can't get it. So there's going to be less. I mean, there's anyway less flow of Canadian into the Gulf Coast just now anyway. And they're importing less of this stuff. You can see they're not refining enough heavy crude because you can look at the yields. You're right, but I just wonder how those two things square.
Yeah, the Guyanan flows have been kind of, a lot of it's been going to Europe rather than to the Gulf Coast, which might have been the more natural home for it, I would suggest. So at some stage it feels as though they just need to bid up for it, right? Or it seems weird that the Gulf Coast refining system can't outcompete Europe, for example, for the resid that it needs.
Cool. Interesting thought there, Phil. Why don't we have a discussion about this kind of internally, and we can come back with some views on that one. But Neil, I think you've made your stance pretty clear there. So why don't we just wrap this up? So what trade ideas do we have now then going forward?
There's nothing really major apart from that. I think I've described the TIA Brent issue, and I think there's definitely support for time spreads, generally speaking, ahead.
Yep.
I don't think there's anything stopping this market just now. What we need is OPEC to come out and say we're going to hike more, because I can't see what else is around, really. There's not been a demand collapse, and US stocks are super tight. If this had been immediately post-Ukraine, we'd be freaking out on tight spreads and flat price. Yeah.
Fair enough. And I guess that OPEC replacement barrel then is kind of a heavy grade as well, which kind of suits the narrative a little bit going forward with where we are on crude needs. Okay. James, recap, kind of what are you looking at over the next kind of couple of weeks? Really short.
Yeah, sure. So it's like a bit of a bone of contention. I can see arguments either way, but I'm moderately bearish ICE gas oil spreads from here, July, August. So I would be monitoring really, if my contention is that we saw these ARBs open up a lot the first 3 weeks of June. So are we actually going to see these imports arrive into Europe in July? So that monitoring that tracking and if we don't see them, particularly from the east of Suez, then it's time to change position.
Yeah, fair enough. And we'll debate kind of August Sept as well over the next week, I'm sure. So, Phil?
Just constructive European light ends, I think, would be the summary of the light ends physical, with maybe the flip side still for the east of Suez, at least until those clean freight rates in the east can come down and make that all a bit more workable again.
Okay, all eyes on TC14 as well in that case. So I think that's a wrap, guys, unless anyone's got anything else to add. Goodness. Okay, so let's wrap up episode 46 of the Sparta Market Outlook podcast. So we've covered a lot this week, from geopolitics and price collapses to freight weirdness, that persistent tightness in the US market too. So if you're feeling like you've just been on a world tour of crude flows and product cracks, well, you're not alone. So look, thanks as always to Phil, James and Neil for bringing the firepower and the barrel puns for this week. And to all of you listening, if you've made it this far and you're either deeply committed to the oil market or just here for the absolute chaos. So either way, we're glad you're with us. Don't forget to subscribe, share with your teammates, and as always, send us your questions, your trade views, or your favourite refinery gossip. We're going to be back next week, inching closer to that 1 year mark, with more signal, less noise, and hopefully slightly less drama in the Middle East as well. So until next time, thanks again, safe trading, and may your east-west not blow out before lunch.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.